Hello, everybody. Thanks for joining us today. This is Tim Travis, and we're going to talk about kind of an opaque area of the market, closed-end funds. We're going to talk about how you can take advantage of them and why, as an asset class, they can present attractive opportunities from time to time, and we think there is one currently. So let's go ahead. Let's get started. Firstly, there's risk in all investing. This is for educational purposes only and is not financial advice, and past performance is not indicative of future results. So basically, a closed-end fund is a type of mutual fund that issues a fixed number of shares through an IPO to raise capital for its investments. And its shares can then be bought and sold on a stock exchange, but no new shares will be created and no new money will flow into the fund. In contrast, an open-ended fund, which is what most mutual funds are and exchange-traded funds, they accept a constant flow of new investment capital and they issue new shares and buy back its own shares on demand. And many municipal bond funds and some global investment funds are closed-ended. So it's a smaller portion of the market. It doesn't get a lot of attention. There tends not to be as much money for Wall Street to be made by really, recommending them or anything like that or selling them. So it can be fertile grounds for value investors. So key takeaways, the initial capital for a closed-end fund is raised through that one-time IPO. The shares may then be bought and sold every day, trading publicly on like any stock. And closed-end funds are usually actively managed, unlike index mutual funds and ETFs, and they typically concentrate on a single industry, sector, region, asset class, that sort of thing. So why closed-end funds offer attractive opportunities? So because closed-end funds trade daily just like stocks, prices vary far more rapidly than the underlying security values. Okay, so similar to stocks. If you own a let's just say a medical firm, a group of doctors' offices per se, and you look at the cash flows, the balance sheet, that medical office is going to have a business value. Okay, and so let's just say hypothetically it's worth $10 million based on fundamental analysis. Well, if that medical office trades publicly like stocks, the price is going to change every single day. So there's going to be times when the medical office is overvalued, when the market's overly optimistic, and there's times where it's going to be undervalued when the market's overly pessimistic. So closed-end funds work the same way. There are times when closed-end funds will trade at steep premiums to net asset value, and there are times when they'll trade at material discounts. Buying CEFs when the discount spreads are historically wide can be an attractive long-term investment opportunity. Either the discount can close via mean reversion, or the fund manager can potentially attempt to close the gap by buying back shares, which also accretively grows net asset value per share. So net asset value, for folks that don't know, it's just you take the assets minus the liabilities, and what you're left with is the net asset value. And because these are, basically a collection of securities, that usually are pretty transparent, that's how you can assess it. So the net asset value does change. Some funds post them monthly, some daily, some quarterly, but you can look at the fund and see what the latest net asset value is and then kind of go from there. Many closed-end funds pay attractive dividends and offer wide diversification within the underlying fund portfolio. So it's not uncommon to have over 100 securities within the portfolio. So they're usually pretty diversified. So let's take a look at BlackRock Floating Rate Income Strategies Fund, FRA. So this strategy fund is designed to provide shareholders with a high current income and high preservation of capital as well. So it's It's consistent with an investment in a diversified leverage portfolio consisting primarily of floating rate debt securities and instruments. The fund seeks to achieve its investment objective by investing under normal market conditions at least 80% of its assets in floating rate debt securities. Okay, so floating rate debt. So when we're talking about bonds or fixed income, we have adjustable rate, floating rates, or we have fixed. So if I'm Procter and Gamble and I'm issuing 10-year debt and the coupon is 4%, that would just be a fixed bond. If it's adjustable, it might be linked to like LIBOR, or the new one is SOFR, and based on that metric, which is linked to the rate at which, let's say banks will lend to each other, for instance, the coupon on the bond will adjust accordingly. So maybe it's 4% plus LIBOR, and so the higher rates go, the higher that coupon goes. And so the benefit is you have much more inflation protection on a floating rate bond than you do on a fixed bond. So the values won't decline nearly as precipitously when rates go up. So the rule of thumb is every 1% increase in interest rates results in about a 7% decline in the value of a 10-year treasury bond. So this is a good way to confront that. So that's what FRA does, is they invest in a broad-based portfolio of these types of instruments. So the value proposition of FRA: on May 30th, we bought the stock today at $11.55 per share. As of the most recent NAV update, which was on May 26th, the net asset value was $12.87, and the dividend yield is very high. It's 11.58%. Okay, so heck of a yield to get, much better than most bonds you're going to find, and most bond funds. So by buying FRA at $11.55, not only are we getting that 11.58% dividend yield, but we're also getting it at a 10.3% discount to its NAV, providing potential upside. So, that's nice little boost. So you have a little bit of a margin of safety there that is kind of unique to closed-end funds. If you're buying a similar product in an open-ended traditional mutual fund, well, because they're issuing shares for new money or buying back shares, you're not going to get that discount to the NAV. And so that's kind of why closed-end funds can be attractive. And then, if you look at FRA historically, you can see on this second graph here that the 10.3% discount, it's within its historical within its historical range. It's not the lowest it's ever been. It's not the highest it's ever been by any means. But I do think that if you see the Fed likely done with rate hikes, I think that you'd start to see that discount converge a little bit and go and get a little bit lower, which means the price of the closed-end fund would go up, the share price. So I think it just provides kind of a nice little tailwind in addition to that 11.58% yield. And so, just building a fixed income portfolio, if rates continue to go up, well, these bonds, they adjust accordingly. So it provides a little more protection against inflation than most other bond portfolios do. So this is just a little information about closed-end funds and FRA and how you can use it to your advantage. We do own them at my firm and personally. So thanks so much and have a great day.